Investing in dividend stocks can be a great strategy for generating consistent income and creating wealth over the course of time. However, not all dividend stocks are made alike, and it is essential to have a solid understanding of the guidelines that might lead to effective dividend investing in order to maximize your returns. Now that we've established that, let's go over the 20 essential rules for investing in dividends, each of which will be presented in depth for your benefit. 1. Get familiar with the concept of dividends. A portion of a company's earnings is often paid out to shareholders in the form of a dividend, which may be in the form of cash or extra shares. They are an indication of a company's overall financial health and they represent a return on your investment. You can dramatically increase the value of your portfolio over the course of time through the power of compounding if you reinvest the dividends that you get. 2. Be aware of the dividend yield. By dividing the annual dividend per share by the stock's price per share, you can determine the percentage of annual return that comes solely from dividends. This percentage is referred to as the dividend yield. A greater yield may be appealing, but it is not the only thing to take into account, and a very high yield may at times be a warning flag. 3. Pay attention to dividend growth. Businesses that are able to sustainably increase their dividend payments are often well managed and have a healthy financial position. A longer track record of dividend increases may be a stronger indicator of an investment's potential than a high present yield, which may not be sustainable in the long run. 4. Reinvest your dividends. If you choose to participate in a dividend reinvestment plan, also known as a DRIP, your dividends will be used toward the purchase of more shares of the firm. Because of this, the value of your investment can grow over time, which increases the likelihood of a return on your investment. 5. Don't be a yield chaser. Large dividend rates might be alluring, but they may also be an indication that a company is experiencing financial difficulties. When the stock price is going down, but the yield is going up, this can be a warning sign. Before making an investment, you should always do a detailed study to find out the causes behind a high yield. 6. Diversify your investment portfolio. It is essential to have a diversified portfolio, as this is the case with any type of investment approach. This includes diversifying the types of businesses, industries, and geographic regions in which you have investments in order to reduce the amount of risk you are exposed to. 7. Take into account the payout ratio. The payout ratio, which is calculated by dividing the amount of dividends paid out per share by the amount of earnings per share, reveals the proportion of a company's earnings that are distributed in the form of dividends. If the payout ratio is smaller, it could indicate that the dividend is more financially viable over the long term. 8. Comprehend dividend dates. There are 4 important dates that you need to keep in mind: the declaration date, the day on which the dividend will become ex-dividend, the record date, and the payment date. If you have a good understanding of these dates, you will be able to determine when you need to buy the stock in order to get the dividend. 9. Evaluate company fundamentals. Keep an eye out for businesses that have a solid financial sheet, stable profitability, and a competitive advantage in the sector in which they operate. This may instill confidence in you that the company will be able to maintain its dividend payments over time while also increasing those payments. 10. Take into account dividend-paying ETFs and mutual funds. Investing in an exchange-traded fund, ETF, or a mutual fund that focuses on dividends can be a smart alternative to researching individual securities if you do not have the time or the expertise to do so. These funds offer a diversified investment strategy and are managed by industry experts. 11. Be aware of the repercussions of taxes. There are 2 types of dividends, qualified and non-qualified, and the tax rate on dividends can change based on both the type of dividend and the individual's income level. Be aware of these repercussions in order to avoid unpleasant surprises during the upcoming tax season. 12. Be patient. It's all about the power of compounding, as well as the gradual increase of dividends over time. You shouldn't anticipate seeing significant profits right away. 13. Maintain current knowledge of the status of the firm. Maintain current knowledge of the status of the firm by regularly reviewing its earnings reports and news. It is possible that the company's capacity to pay dividends could be impacted by any major changes in its fundamentals or its outlook. 14. Don't neglect small and mid-cap enterprises. Although large, well-established businesses are typically the first choice of dividend investors, it's important to remember that even tiny businesses have the potential to be profitable sources of dividends. It's possible that they have a bigger growth potential, and in some situations, they may have excellent dividend yields. 15. Keep an eye out for reduced dividends. It is possible that a corporation is experiencing financial difficulties if it decides to lower its payout. It is also possible for this to result in a decrease in the price of the stock. Closely monitor your investments, and have a plan ready to implement in the event that dividends are reduced. 16. Invest in things you have a good understanding of. Invest your money in businesses and sectors that you are familiar with and have faith in. If you have a complete understanding, it will be easier for you to make decisions that are in your best interest and to maintain your investing strategy even when the market is performing poorly. 17. Set long-term goals. Having defined goals can help drive your investment plan and keep you focused, regardless of whether you're investing for retirement, to produce income, or to cover future expenses. 18. Be aware of the circumstances surrounding interest rates. The interest rate environment might have an effect on dividend stocks. When interest rates are low, dividend stocks may be more appealing than bonds or savings accounts because they provide higher payouts on investment capital. However, if interest rates continue to climb, bonds may become more appealing investments, which may prompt investors to sell dividend stocks. 19. Keep an eye out for dividend aristocrats. These are businesses that have raised their dividend payments on a yearly basis for at least 25 consecutive years. Companies that fall into this category are typically dependable and secure, making them a potential strong option for dividend investors. 20. Perform frequent audits of your portfolio. It is crucial to frequently assess your assets, rebalance them when required, and verify that you are on pace to reach your financial goals. This is true regardless of the investment strategy you choose. Investing in dividends is an art that requires patience, self-control, and a thorough understanding of the market. You can take advantage of dividends to amass riches and ensure your financial well-being in the future if you familiarize yourself with the relevant guidelines and follow them. Keep in mind that there is no one-size-fits-all strategy, and the approach that will be most successful for you will depend on your unique financial status as well as your long-term objectives. If you liked this video, kindly ensure that you like, share, and subscribe to our channel, so we can continue to create such content. Thanks again for your time and have a great day.